Welcome back. In this lesson we will explore in detail why stocks get mispriced, how our mind sometimes works against us, and how this can cause stock market bubbles. Psychology plays a big role in this, and knowing how your mind works will help you to avoid certain common mistakes which cause the majority of investors to lose money on the stock market. We have all heard the tales of experts who perform worse than monkeys when it comes to picking stocks that will outperform the broader market index. And the average individual investor performs even worse than that. However, monkeys have an unfair advantage. They do not have a business degree, they do not follow the news, and they do not care about money. Let me explain. A big part of contemporary financial theory is based on the so-called efficient market hypothesis. This theory assumes that every investor acts rationally, with the result that the market price of a stock always perfectly reflects the absolute value of the underlying business. If this were true, it would be impossible to exploit mispriced stocks and earn above average returns, since there would never be a difference between price and value in the first place. While the efficient market hypothesis is a pretty mathematical model, it is fairly useless in the real world. Why? Because, as we learned in previous lessons, investors generally act irrationally. Stock prices deviate from underlying business value all the time. Warren Buffett has proven that the efficient market hypothesis is untrue by consistently earning above average returns year after year. He even said, "I'd be a bum on the street with a tin cup if markets were always efficient." Still, Buffett does not reject the efficient market hypothesis altogether. He believes that markets are efficient in the long run, but highly irrational in the short run. But what causes this irrational behavior? One word: emotions. Money does strange things to people. Gaining money tends to make people greedy, which results in high prices, while losing money tends to make people depressed, leading to irrationally low prices. This emotional roller coaster is a perfect breeding ground for irrational behavior. The kind of behavior which leads to the mispriced stocks value investors like so much. Besides fear and greed, which we already covered to some extent in earlier lessons, there are several other factors which affect our ability to make rational decisions. In fact, rational decisions are almost as rare as finding a unicorn sunbathing. The reason is that our decision-making process is seriously impaired by numerous cognitive biases. This is how Wikipedia defines a cognitive bias. A cognitive bias is a pattern of deviation in judgment, whereby inferences about other people and situations may be drawn in an illogical fashion. This is a rather difficult way of saying that our minds distort some of the information we receive in such a way that it can cause us to make irrational decisions. There are currently about 170 cognitive biases known to researchers. That's right, 170 ways in which our brain distorts the information we base our decisions on. An entire field of research called behavioral finance has emerged to study how these biases affect our financial decision making, and their research goes straight against the efficient market hypothesis. Let me give you some examples of cognitive biases which influence our decision-making process. We will start with a simple yet powerful concept called prospect theory. Research in this area revealed that humans are in general risk-averse when it comes to managing their money. Would you rather take a certain $500 gain or a 50-50 chance of earning either $0 or $1,000? Most research subjects chose the certain gain over a chance of earning more. When it comes to losses though, subjects were willing to take more risk to avoid having to take a loss. In this case, they chose luck over certainty. This behavior can ruin your returns on the stock market. You could sell winning stocks too early because you'd rather take a certain profit, and you might hold on to losing stocks for too long because you prefer to take a chance that the stock price will recover at some point rather than take a certain loss. This creates tremendous opportunity costs. This does not mean that you should sell as soon as the price starts declining though. However, to avoid holding on to losing stocks for too long, You have to be willing to pull the trigger and take a loss when there are fundamental problems with the underlying business. You need to have a clear selling strategy and stick to it. We will elaborate on this in the last module of this course. The availability bias is another interesting finding from the field of behavioral finance, which teaches us that people tend to value recent news more than older news. This creates a short-term mindset, while investing is a long-term process which requires patience. This bias also sets the stage for several other wealth-destroying tendencies, like overreaction to news, which often causes irrational price movements around newsworthy events, but also herd behavior, where people blindly follow the actions of the majority. We learned before that following the majority will earn you mediocre returns at best. The only way to have above average performance is to do things differently from the crowd. Another common bias is confirmation bias, which makes people more likely to seek out information which supports their beliefs rather than information which is contradictory to their beliefs. This is dangerous for investors, because once they believe a stock is a good buy, they might lose sight of any warning signs, since the confirmation bias focuses their attention on information which supports their belief that the stock is a good buy and away from any information which contradicts this belief. The cumulative effect of countless of these irrational investment decisions can cause financial bubbles and crises. A bubble is a period in which prices rise way higher than underlying value, creating a situation of massive overvaluation. At some point, people wake up and realize that prices have risen to irrational levels. At this moment, the bubble bursts and prices fall rapidly, causing misery along the way. History is filled with examples of destructive financial bubbles. The US housing bubble is a recent example. Banks gave people massive mortgage loans. This made more money available to buy houses, which artificially inflated the prices of houses to irrationally high levels. However, many people were unable to pay their huge mortgages, and they were forced to sell their house in a foreclosure. Once a tipping point was reached, housing prices started a free fall, leading to a credit crisis and partly causing a recession in the US. A well-known example of a stock market bubble is the dot-com bubble of 2000, which I have mentioned before in earlier lessons. Between 1997 and 2000, internet companies were all the rage. Everyone wanted in. Speculators were trying to get rich in a short time, and abundant venture capital was inflating stock prices. However, most of these internet companies were spending millions but were not earning any money. An article by the American journalist Jack Willoughby, called Burning Up, pointed out that stock prices of internet companies had deviated significantly from underlying business values, and he predicted the bankruptcy of dozens of companies within a year. His predictions came true. The stock market came crashing down, and even the companies who survived this crash have never risen to those heights again. Microsoft, for example, was trading at 58 at its peak in 2000. Now, more than a decade later, Microsoft is still trading 50% below that. This was just a tiny selection from a broad range of examples, but these bubbles show how destructive irrational investment decisions can be. The best way to reduce the effect of the cognitive biases we discussed and to avoid getting caught in a bubble is to tune down the daily dose of financial news you take in and removing emotions from the equation by sticking to a strategy based on cold, hard business facts. This will make you significantly less likely to get caught up in irrational panic or euphoria. In addition, follow the advice of Mark Twain. Whenever you find yourself on the side of the majority, it's time to pause and reflect. It should now be clear to you how these psychological tendencies can negatively affect your investment decisions and lead to creation of financial bubbles and crises. However, despite the fact that every person on earth is affected by these biases, some investors seem to be able to overcome or circumvent these cognitive limitations. It is this relatively small group of investors who is able to consistently earn market-beating returns. So what is it that separates these investment grades like John Templeton, Monish Pabrai and Warren Buffett from the average investor or Wall Street expert? The short answer: their mindset. Let me elaborate. A house needs a strong foundation or it will come crumbling down, and the same goes for an investment strategy. The foundation in this case is the mindset of the investor. Warren Buffett would have been unable to amass his billions had he let his emotions influence his investment decisions, because no matter how good your strategy is, if you are unaware of the way your mind works against you when it comes to investing, you will most likely fall prey to irrational behavior, which is detrimental to your returns. Your emotions have the power to render your financial education and investment strategy completely useless. This is why monkeys are able to beat Wall Street experts. Being aware of this fact is the first step towards better returns, for it allows you to take some countermeasures. To summarize, on average, financial experts perform worse than a monkey when it comes to picking stocks. The efficient market hypothesis is an outdated theory which states that it is impossible to ever perform better than the market average. Warren Buffett believes markets are efficient in the long run, but highly irrational in the short run, and these irrational prices is what he exploits to consistently earn above average returns year after year. Irrational prices are caused by emotions and cognitive biases, which cloud our decision-making process. Behavioral finance studies the effect of cognitive biases on our financial decisions. The cumulative effect of countless of irrational investment decisions can cause financial bubbles and crises. The best way to counter the effect of cognitive biases is by removing emotions from the equation, by following the financial news less closely, and by sticking to a strategy based purely on business facts. In order to earn above average returns, you have to do things differently from the crowd. Your emotions have the power to render your financial education and investment strategy completely useless, so having the right mindset is crucial to your investment success. Now that you know the difference between price and value, and also why stocks get mispriced, it is interesting to look at so-called catalysts of value realization. In earlier lessons, we learned that it can take up to several years before a mispriced stock gets reasonably priced again. Catalysts are events which can speed up this process, which means your profits grow faster. See you in the next lesson.